Welcome to today's presentation, Mastering Breakouts and Breakdowns. My name is Dan Gibby, Senior Pristine Trained Trader and Lead Moderator of Pristine's Advanced Stocks and Derivatives Trading Room. I have been studying the Pristine method under the tutelage of Pristine co-founders Oliver Velez and Greg Capra since 1998, mastering the art, science, and psychological challenges of the self-directed active trading. Since trading full-time in 1998, I have been a very active trader of stocks, options, and futures. Pristine is the leader in the industry, being ranked #1 educational firm by Barron's, Forbes, Stocks and Commodities magazine, just to name a few. The Pristine method is a specific, objective method of analyzing the financial markets and predicting stock movements based on price charts, volume, and trader sentiment. This presentation today is not about teaching chart analysis, but about intelligently showing you one precise, highly reliable setup called the breakout. Breakout and breakdowns, of course, and the various intricacies of showing you the quality setup to make you focus only on the very best of the best. Although it is impossible not to discuss basic, pristine technical setups and terminology, I recommend that you review this DVD again after you have completed our complete seminar series on the Pristine method, parts 1 and 2. So sit back, get comfortable, as you are about to embark on a most exciting educational journey of how to technically and precisely trade breakouts and breakdowns like never before. Before we get started, however, the SEC wants us to remind you that trading involves speculation, which involves risk. So therefore, you can lose a lot of money in this business, particularly if you don't objectively have a trading plan and know exactly why you are engaging in this speculative activity called trading. But we actually believe that not having the proper education is what's going to lead to the much greater losses. Let's look at the introduction here of what we're going to be covering here in the next couple hours. First, I'll go over the introduction a little bit more of the Pristine method and our style of approaching the markets in a technical way, various trading styles and time frames, and a brief introduction to what a trading plan is and its necessity in trading objectively in this business of trading. Then I'll cover a section on the basics and the foundations necessary before embarking on analyzing various breakout and breakdown setups. I'll give you a description of what congestion area means as opposed to a multiple, what I'm going to call fluid bar moves and their significance in trading breakouts and breakdowns on multiple time frames. I'm going to explain to you what we call a wide range bar, whether it is green meaning bullish or red meaning bearish, and the importance of getting one of those in igniting new breakouts or breakdowns from consolidations. Obviously, we'll need to cover volume and the significance of that in adding some benefit to the reliability of breakouts and breakdowns. And then we'll get and talk about quality consolidations, which will increase the odds of a breakout, versus questionable consolidations or bases. Pristine ESP is Pristine's proprietary software that simultaneously scans from whether it's a 2-minute scalp trade to a core trade, every single setup that Pristine teaches. It's an invaluable tool to any trader, and I'm going to show you how to successfully use it every single day as a breakout, breakdown master trader. The various breakout, breakdown strategies or setups, if you will, that we're going to cover in this DVD are outlined right here. We're going to break them down into easy to digest modules as follows. The initial breakout, breakdown. Breakout, breakdown from these wide range bars that I just referenced. A breakout, breakdown from a gap that's igniting a new breakout breakdown. The first retracement after an initial breakout breakdown. Then, of course, you have secondary breakouts and breakdowns. Huge difference in quality of all of these, but I'm going to teach you a very reliable technique of buying secondary breakouts and breakdowns, which the industry, believe it or not, does horribly. Many instances that will actually be taking the other side of what we call those novices. Finally, the late day breakout breakdown is an incredibly accurate technique that we can teach to almost anybody. If you want to just trade 1 hour a day, you can go play golf in the morning, you can have a side business, and you can come back for the last 2 hours of the market hours wherever you happen to live on the East Coast, West Coast, even over in Southeast Asia. And I will teach you specifically how to search for these high probability quality breakouts, and you could specialize in trading nothing but these particular trades. And then I'm going to give you, just finish with one very interesting breakdown strategy that we have discovered, and it's a setup that involves a gap, either bullish gap or bearish gap, that was negated in the morning session and then sets up a quality breakout breakdown. Let's just briefly mention what this seminar is not about. I mentioned I can't teach you the Pristine Method Part 1 and 2 in this 2 to 3 hour DVD here. Instead, you're going to need to, serious market participants need to take the entire 4-day series, which is 2 days for each Pristine Method Part 1 and Part 2. I'm not going to be talking in detail about a trading plan, although I'll give you an introduction and the importance of a trading plan here in a moment. Managing your trading business. Trading is a business. We have a separate seminar at Pristine that Malcolm Murray has developed called Managing Your Trading Business. I'm not going to get into that at all in this particular DVD. Risk management is of the utmost importance in any speculative endeavor, particularly in trading. Managing risk is number one priority. I'm going to give you a little bit of that information in terms of where to put your protective stop in these particular setups, but I can't in this brief DVD get into various trailing stops and pivot analysis or proper share size, the psychological aspects of trading, which is a very significant portion to a successful trader. We are not covering that in this DVD. Futures, options, commodities, and other derivatives we aren't going to discuss. Classical analysis, macro or fundamental is beyond the scope of this. We aren't going to be talking about level 2 trading or any other of the topics specifically addressed in our Pristine Trading University, which I highly recommend each and every one of you spend some time in looking at those topics and DVDs. Every single one of them is of the utmost quality and benefit to you. Who is Pristine? Pristine Capital Holdings was established in 1994 by Oliver Velez and Greg Capra. We provide the insight and intelligence to help you become a master self-directed trader. We are not a buy and hold tip service where we just give you ideas and you follow them blindly. Our goal is to teach you how to intelligently and consistently approach the markets day by day, whatever instrument you want to trade, from stocks, commodities, currencies, and allow you to develop a trading plan to know exactly what patterns that you are looking for, exactly how to enter them, and exactly how to manage them. It's interesting that people view irrational things they don't understand. But Pristine teaches that the only thing that really matters in trading is price action. Is an imbalance of supply and demand is the only thing on planet Earth that is going to move a stock. So the markets are not irrational. People in their decision making are irrational who fail to focus on the only thing that matters, which is what we teach. Sound technical advice in addition to public sentiment and market internals. Everything we offer from our services and products would enable you to obtain that basic understanding. These are some of the services that we accomplish that. Obviously, we have on-site seminars where we give you the Pristine Method Parts 1 and 2, among other subjects. We teach those same things online, in addition to many coaching topics online. In the top right is the taskbar for the Pristine ESP scanning software that I mentioned. Right in the middle there are real-time trading rooms. We have 3 of them. I co-moderate the Advanced Stocks and Derivatives Trading Room. We have the Pristine Method Trading Room, which is ideal for the beginning trader who has just graduated from the Pristine Method Part 1 and is looking for that hands-on bridge the gap from theory to practice. And then finally we have an E-mini trading room. With the advent of all these electronic instruments that are very efficient, we have a room specifically designed to help the trader of these new E-mini contracts. Greg and Oliver's best-known seller book, Tools and Tactics for the Master Day Trader, is an absolute must-read Bible for all traders. The first half of the book focuses more on the proper psychological mindset required to succeed in this rigorous business. The second half being an introduction to the proper technical aspects, the setups, the entry, and the management, which you get much more involved in, obviously, the Pristine Method courses, Part 1 and 2. You see DVDs there. That's what you're viewing right now, hopefully. Hope you're viewing this many, many times over. Under our Pristine Trading University, that's where you will find our full catalog of those subjects. Finally, our plethora of trading newsletters from the active swing trader, which is our niche. Pristine Capital Holdings was actually started with the birth of the Pristine then day trader, now called Pristine Swing Trader, where we attempt to find those technical patterns that will give us a high probability 1 to 5 day gain. Then we have a lighter version of that. We have a core trading version. We have various option newsletters, etc. So I highly recommend that you spend some time looking at all of the services and products, both premium and free, at Pristine.com. Pristine's success in the industry since 1994 has not gone unrecognized by the media. We have been ranked number 1 by an educational firm by Barron's, Stocks and Commodities Magazine, and Forbes, among the many other public accolades as you see here. What does it take to be a successful trader? There are many books written on that, and the debates can go on and on. Here's a simplified version which we believe covers the main components. First of all, trading is a business, and you must treat it like one. If anybody is approaching trading for recreation or a hobby or something fun, we recommend that you just close your account down and protect your capital, and instead fly to Las Vegas or something and do something more fun, where the market, for those who are not trained in it, finds a way to rip away not only your financial well-being, but your emotional, sending you home broke and dejected. We don't want that to happen to you, and it shouldn't if you follow everything we teach. Next, you have to choose a defined method. We teach the Pristine Method, which is our objective approach to trading price action and sentiment. We do not teach Gann square. We do not teach Fibonacci retracement, buy and sell setups per se. We don't teach reading alignment of seasonal planetary alignments. We teach the pristine method because we believe it's the best. Next, you need a time frame to choose to trade from. I have many traders who are just scalpers to morning day traders where their world, so to speak, is the 2-minute, 5-minute, and 15-minute charts. And they can do that for part of the day or the entire day. There's nothing wrong with that. I have other students, traders, clients, who don't want to even look at the market 1 minute while it's open. Instead, they apply the pristine method to their long-term portfolio by sitting at their pool on a Sunday afternoon sipping iced tea. Whatever is your personal style, you need to apply the pristine methodology objectively to those time frames. Choose which instruments you're going to trade. Some people trade just stocks. Some people trade maybe only 1 or 5 stocks is their trading universe. Some people trade just futures, like some of those people in our E-mini trading room. Some people trade just currencies. I personally trade anything that moves, as my students have witnessed. Anything that has a compelling pattern, that has sufficient liquidity, that gives me a high reward to risk ratio, which means my potential target less my stop, I will trade it. I will hit the button and apply everything we teach in live practice. Money management. Again, I'm sure there's many books written just about this topic alone, but rest assured that without proper money management, you are destined for failure in this business. And in fact, with many of my students, to illustrate this point, when they're in our pristine labs or even our in-house trading, where they're trading right next to me, they're running their business as I'm running mine during the market hours, I will go to their trading simulator and I'll tell them to buy a whole inventory of stocks, and I'll just say manage it. You know, a monkey, right? The Wall Street Journal and financial media have done studies that a monkey can do 50-50, just the dartboard, throwing darts against stocks to buy. I don't disagree with that. But if you have proper money management, any portfolio can get dropped on your lap, and you can weed out the inventory stocks. I call it inventory because that's all it is to a pristine trained trader. Is our inventory is our instruments that we're trading. No different than any other retailer trading their inventory. Whether it be the sport coat, whether it be a Mercedes car, whether it be a golf clubs, it doesn't matter. We are trading these instruments, stocks, futures, and commodities, with the intent to profit once we close that transaction. So provided you have proper money management, we get rid of the inventory that's not working, keep the inventory that is. I can make money consistently with anything being thrown at me. Finally, discipline and patience to follow your method. It pains me when I see people in our live real-time trading rooms, or even friends I hear at the gym or in an elevator, whatever the case, they feel a need to be engaged in the market when the odds are not in our favor. I want you to shut down your computer, to read the newspaper, to go take your dog for a walk, whatever you want, when the odds of you engaging in the market in accordance with the setups you trade and the market internals being favorable to those trades, when they are not in alignment, cash is a position. We purposely engage in the market when the odds are in our favor. So I want to see you, as I said, reading the paper and whatever it takes to have the discipline and patience to say, no, that's not my setup. My checklist is not in alignment for me to engage in that trade, so therefore I do not enter the trade. It's that simple, but it takes some practice through psychological coaching and training. Here's a brief little successful trader matrix, if you will, that I put together. And I'm showing you how it interrelates with a trading plan. You see right in the middle up top, all capital letters, compelling technical pattern. No setup, no trade. We are trading as market technicians chart patterns which, based upon history, have a high degree of reliability of continuation in the predicted manner, as the chart suggests, because human nature repeats itself. And price charts are a reflection of human behavior through their supply and demand. Charts don't lie. People put their money on the line, which creates these charts. And that's why we are not fundamentalists, because money, charts, fear, and greed is what's going to move that stock. Not an earnings statement, not an upgrade, downgrade, not a change in management, not a new product. None of that is going to make the stock move. Only an imbalance of supply and demand. So no compelling setup. We don't even continue through our pre-trade question checklist at all. We're looking for reasons not to enter the trade. I have copies of the 3 DVDs that my colleagues have made, which interrelate in this process here. Greg Capra, president of Pristine, has 2 of them here at the top here, intermarket analysis and market internals, that you can find on Pristine Trading University. Both of those are also integral to helping you find not only the compelling patterns, but making the reliability of those patterns have a higher degree of accuracy when the intermarket analysis and market internals support that bullish or bearish compelling setup that you are considering. Once we find a compelling setup and the market internals agree, then you simply properly share size, which means you calculate the maximum loss that you should incur if you are stopped out, but for a disaster gap, which we can't prevent in this business unless you use some partial hedging techniques. So once you enter the trade, there is nothing to do except manage in between. We've entered the compelling setup, we've proper share size, we've set our protective stop, and you simply manage the trade in between. You are either going to meet target or exceed it or scale in and out. We teach various scaling techniques in all of our courses. Or you're going to stop out. But if you know and have confidence in the setup in the first place, and you've accepted the loss, and the reward to risk is over 3 to 1, there's nothing to fear. And those that do fear means that they don't have the confidence in the pattern or trust in themselves that they're going to follow the rules. The column on the left, called trading plan, are just some of the components that should be part of your plan. And a trading plan, bear in mind, is a component of the overall business plan, since trading is a business. And then, so that would include what type of corporation you are, where you're located, your hours, etc. And this whole trading plan portion is what type of trades am I going to take, under what conditions, what instruments, what do the market internals have to look like before I get out, what type of trade managements do I have? Am I going to sell a third after a multi-bar move and then trail half under pivots? That should all be in writing. And we at Pristine can help you prepare your trading plan through through various coachings, but also Paul Lang has one of these DVDs on how to create this trading plan that I have a copy here for you on the bottom right. On the prior slide, I showed you step 1 is a compelling pattern. This is just a summary sheet of some of the compelling patterns that we teach in the Pristine method. There's many of them. PBS stands for the Pristine Buy Setup, and you can see a little stick figure of that in the top right diagram. Very, very reliable, controlled pullback in an uptrend. We teach in the Pristine Method Part 1 the entire first day of the 2-day seminar teaches you, once we get through the introductory stuff explaining the only possible ways that a stock can move through 4 stages, we spend the entire afternoon teaching you how to find these quality pristine buy setups, and we give you a nice outline of amplifiers, if you will, to help you find the best of the best. So see, that's an entire day's course, and you can see why I can't teach you that in a 2-hour DVD. The Pristine Sell setup would be the opposite of that, obviously, in a downtrend. We teach climactic buy and sell setups, when the rubber band of fear or greed has gotten too far, and how to intelligently ride that rubber band back for a partial retracement. Guerrilla trades. We teach in the Pristine Method Part 1 12 highly reliable guerrilla trades, 1 to 2 day hit and run tactics that could go out as far as a 10 or more day gain on some of them. Breakouts and breakdowns. We teach this obviously in the Pristine Method Part 1, but because that course, both of the Part 1 and 2, our manuals are over 300 pages, and people's heads are exploding when they leave those courses, is actually why you're watching this DVD here today. We have 100 slides here on this one subject alone. So we are going to, for those of you who are watching this, I commend you for taking the ridiculously small cost of this, as you're going to see the benefit that you're going to get by viewing this should be 100-fold, if not more, because I'm going to change the way, as I said, you view breakouts and breakdowns for the rest of your life. So my goal is to make you become a specialist in this. We teach W&M reversal formations. We teach a pinch play. We have many failed patterns that we teach. Finally, one called the bearish gap that bullies. Sounds a little strange, but it's a derivative of one of these failed patterns. And when a breakdown sets up from this, then we're going to conclude with that little bonus setup. All right, let's go ahead and continue here and jump right into the foundation now. Some introductory concepts here. This, and you'll notice on all of these slides, the majority of these slides, since Pristine teaches trading, price action, and candlesticks, I rarely, if ever, am going to give you the name of the stock or even show you the price of it. Why? Because it doesn't matter. This, I'll tell you, just in case you're curious, is a 15-minute chart of the ES, the S&P E-minis. Does that matter? Absolutely not. It could be a lumber commodity future contract. It could be the euro. It could be Dell Computer, Taser, RIM. It could be any other any instrument whatsoever. It could be trading your brother-in-law's. As long as the chart is based on supply and demand and human emotion, the Pristine method can trade it. But let's look at some of the concepts relative to breakouts and breakdowns. You can see that this stock broke out from a consolidation at the low, ignited a big new strong move to a new uptrend, and then is just consolidating near the high of that big bullish run. So the first thing that we're going to talk about is basis and consolidations. What does that mean? That it's going sideways up here. What about various types of breakouts and breakdowns? I showed you the whole chapter, the 6 types that we're going to cover in this DVD. The quality of one setup versus another. Is that a prior fluid move, or did it chop its way up on that breakout? And what's the significance of that if I want to buy a breakout or breakdown? Is this particular setup right here, do I have a bias to trade it up, or do I have a bias to trade it down, and why? And I will show you how to intelligently and consistently you can use Pristine ESP to find various setups on breakouts and breakdowns. Congestion areas. Prices on anything move between areas of support and resistance. These congestion areas that I have circled here for you are congestion. It's just a sloppy congestion or consolidation, and they have overlapping bars, overlapping tails, they have gaps, and it's an indecision area. A fluid move, however, you can see once it did decisively break out, the ambiguity between the bulls or indecision rather, between the bulls and the bears in the congestion area has been resolved to the upside. So whether that brought in new buyers or the shorts covered is the same. Demand then overwhelms supply, or demand buying overwhelms selling, and the stock continued to move robustly to the upside. So that's what we call a fluid move. When you don't have the congestion, you don't have the overlapping bars and tails. It's a nice controlled equal move up. As soon as one bar ends, the next bar is moving up. Prices now retrace easier without congestion to the left. So actually go back in your slide, and I want you to take a big note that when I said you do not take any trade whatsoever unless you have a compelling pattern, implicit in that statement also, in relative to the reward to risk ratio, is it has to have no congestion in order for it to meet its target. Quality pattern and room to move to the target. So that's the note I want you to make. Now I want to show you this intraday pattern and how that's going to be significant to breakouts and breakdowns. These are two separate 15-minute charts. The one on the left had this fluid move into the close. So if the next opening print, the next day, you can see it gapped up a little bit there, there is a much higher chance of that stock retracing back down into that fluid move because there's not much congestion to halt a retracement. The stock on the right, in contrast, had a big bullish multi-hour sideways consolidation into the close. So that sideways consolidation provided a big base of support. So if this stock now gaps up over that, the same indecision now is resolved to the upside, and all of this consolidation becomes support, suggesting a gap breakout here that you would want to buy some kind of intraday entry or 5 or 15-minute high on this. We have one of our sections is trading gaps, and this concept we'll be covering more of later on. Volume and how that's going to affect the pattern of our breakout or breakdown. Volume is money. It's people putting their money on the line. We teach volume in both the Pristine Method Part 1 and 2, but it represents people's commitment or lack thereof to a particular pattern. So think of it this way. Price charts, supply and demand, tells us what a stock is doing. It's either moving up, down, or sideways. That's the only thing a stock can do. But volume tells us how that stock is moving up, down, or sideways. So it's good to read the two, that if bullish volume supports a bullish move, that's bullish, and vice versa. As a general rule, we want at least 500,000 average volume over the last 30-day average minimum. And in fact, I would recommend for most beginners that you raise that to 1 million, because without sufficient volume, the intraday whips and liquidity is less, and then when trying to get in or out of it, you could get more slippage that way. Volume increases should occur in the direction of the breakout. So you can see on the little stick figure to the right, number 1, that should have corresponded with a breakout. Then on the pullback on the stock, you should see reduced volume. So that would be number 2. Then increased volume again, number 3 there on the breakout. So this is an ideal volume situation to an initial breakout, the first retracement, and the secondary breakout, which we'll be covering in the very next chapter. If volume is increasing without the price moving, that's a warning sign. And secondly, a bullish breakout in price without an increasing volume is also a warning sign. Volume, however, is everything. Well, let me say everything is secondary to price. Price is king, because that candlestick on whatever time frame you are focusing on every candlestick is showing the open, the close, the high, and the low of that period. And that is what is king. And then we just obviously use the volume and these other amplifiers that I mentioned that we teach in the Pristine Method Part 1. And in Pristine Method Part 2, we have all these we divide them up into subjective and objective. We layer additional things onto the trade to make it more reliable. So what's a proper base or consolidation? Well, first, a consolidation, what is it? It is what it is. We at Pristine, we use the word objective a lot. And objective, if you just look it up in Webster's, means existing in fact, presently observable. You'll hear Greg Capra say over and over again, it is what it is. So a consolidation, it's a resting period in a trend. So we don't know if that resting period is going to break up or down. But you will have that answered at the end of this DVD. What we are looking for in buying or considering engaging in a breakout or breakdown from a consolidation is we want a quality, controlled, tight consolidation with few to no overlapping bars or significant gaps or tails. Because if it's tight, that means the bulls and bears are just in an agreed upon consolidation. If they are whipping back and forth more violently, then the bulls and bears, through their buy and sell orders, are fighting more aggressively for control of the stock. And then that's the consolidation that we want to stay away from, because we only want to trade with the bull or bear, whichever one is more decisively in control of that stock on that time frame. This resting period is going to provide the base of support if we break out, or if it breaks down, that's going to be the base of resistance. And that's where our stops are going to be on breakouts or breakdowns, is above or below the consolidation area. And I'm going to be teaching you these low-risk strategies under the Pristine Method. Here's a couple examples of quality, tight consolidations. Top left, up on the day, tight consolidation into the rising 20-period moving average. That's an excellent example of a late-day breakout, which we have a whole separate chapter on coming up. The bottom left, same thing, up on the day, consolidated near the high for many, many bars. The one on the right is a trend change. It was in a very bad downtrend, then rallied robustly off the low, and is going sideways instead of retracing back down again. So that's a quality tight consolidation, ready to buy a new breakout of that, because that consolidation will be the support on a breakout. Now, here's an example of what we are not looking for. Look at, even though these are consolidating by definition, they're consolidations in a downtrend, it has many tails, it has gaps, different size bars, and the bulls and bears are in violent fighting for who's in control of this stock. These are the pictures that we want to stay away from. Pristine ESP, again, is our proprietary scanning software where the software looks for every single trade that we teach. And then there's different modules both on time frames and tactics that you can program in, and I'm going to show you exactly which ones that we use for finding not only breakouts and breakdowns, but that one strategy that I mentioned to you at the end of this DVD where the bullish or bearish gaps are negated. I'll show you exactly how Pristine ESP finds those for us. Some general comments here on breakouts and breakdowns. Can be traded on any time frame and in any trend. Every trade, though, needs a compelling pattern and little congestion. So that's what I highlighted for you a few moments ago. So if I want to buy a breakout, the next reference point of resistance has to be far away. If I want to short a breakdown, the next congestion area of support, when looking to the left, of course, has to be far below. If there's nowhere for the stock to move, even if it does break out or break down, we stay away from it. Increased volume is a plus on all breakouts and breakdowns. Not all new highs or lows are buyable and shortable. I'm going to show you which ones have the highest odds. Can somebody walking off the street watch this DVD and hopefully learn a lot and start making money after successful paper trading? Absolutely. I strongly believe that. But applying the other concepts taught in the Pristine Methods, Part 1 and 2, is going to increase your confidence and reliability of these patterns tenfold. And Pristine ESP, I'll show you throughout how to find these candidates. Determining targets and stops. Every single trade needs the generous reward, which is how far do I think my stock can move to, versus my risk is what is the stop loss that I need in order to let this stock perform. As a general rule, Pristine looks for a minimum of $3 target to a $1 stop, or 3-to-1 reward to risk. Our targets are measured by this. If we're going long, it's resistance or consolidation. If I'm shorting, it's support or consolidation. Then, generally, just a general rule, after a multi-bar move on the time frame in which you're trading, take half your profits. Or, if it's near a major moving average, near the congestion, that's another place to take part of your money. And then it's up to your trading plan how to manage the rest of it. But as soon as you take half, also move stop break even on the back half. Your protective stops, that's your insurance policy, are always placed under support if you're going long, or over resistance if you're going short. The initial breakout. We teach various ways to trade breakouts and breakdowns, from a sideways trend to a new trend. But I'm going to break these out for you to make them real simple. The initial breakout, the first retracement after the breakout, the secondary breakout, wide range bar out of a base, and then other bullish or bearish retests. And obviously these are going on the short side also. So here's what it's going to look like as a general rule here for the initial breakout, retracement, and secondary. The stock is consolidating, so we want that quality consolidation that I showed you a picture of, and it breaks out through resistance. That's mark number 1 and called the initial breakout. Then the stock retraces in the direction of the prior move, and it reverses at support. We actually call that minor support. A prior high is a minor, so where it broke out at number 1 and retraces to that initial breakout area, that's minor support, first retracement, and that's the safest entry point, provided it retraces in a controlled manner. And I'll show you some examples of those. If it retraces violently, which means big ugly red bars instead of nice red bar, red bar, red bar in a controlled manner, then just stay away from those. Number 3 is the secondary breakout. So the stock moves above the initial breakout area, that prior high, and I'm saying here after consolidating at the prior high. And let's move right into that because that's a very important difference. Here's a picture of a quality initial breakout. So the little stick man there had a nice bullish move, consolidated at the high, and then breaks out on increasing volume is a plus. You can buy that initial breakout once it trades over resistance with a stop under the consolidation support. And I have an example for you on the right on a real chart. It's up on the day, consolidating, and you buy the initial breakout, stop under the support. Target will be resistance. Here is an improper secondary breakout. You know, there's some even respected newsletter writers in the industry that, you know, they define a breakout as it just simply trading over a prior high. They'll say, oh, XYZ is breaking out, I recommend you buy it, without taking into account how much the stock has already moved. Pristine, however, I'm going to show you very precisely which of these secondaries to take and which one not to take. So I need to we're going to use retracement analysis to help guide you and make this determination. So Pristine uses retracement analysis to objectively determine the strength or weakness of a move counter to the prevailing trend. What does that mean? Well, look at the bottom there where it says 100. That was what I'm calling the prevailing trend. So the retracement back to that 60% level is telling us that was a deeper retracement than we thought. As a general rule, we don't want the retracements to be greater than 40%, 40-50%, because then that puts into question that prior move. So now the secondary breakout, some people, as I said, I see my friends send me newsletters and I'm like, oh my God, I can't believe they're recommending that somebody buy this thing. It's up 7 bars, and I'll show you an example. As a secondary breakout, I'll show you exactly how to trade these correctly. This is the same stickman, identical, except it's consolidated at the prior high, which means that it's absorbing some of the resistance from that prior high, and additionally, the consolidation at that prior high is building a higher range base or consolidation. These are the type of secondary breakouts that are buyable with a stop under that green horizontal consolidation area. So if a stock doesn't consolidate up there and it's just a multiple bar move through a prior high, as you see in the first bullet, I'm looking to sell into strength, because all kinds of alerts will be going off on traders' workstations around the country. Oh, 1 month high, 52-week high, whatever the case. And if it's extended, I just sit back, wait for it to lose its momentum on that time frame, and I sell into the strength, because the odds of it retracing after making new highs is very high. This first bar, I have number 1. So let's apply a couple of these terms that we just went over. So see the sideways channel consolidation. It's just consolidating in a channel. There's absolutely nothing to do at that point in time, trading-wise. It would just be dead money to us. Then, after you have that wide range bar after the failed breakdown, now you have my attention, that's the first sign of an impending breakout, because one bar engulfed the prior 3 and closed right at the trend line, retraced 2 bars, and then broke out again. That's the initial breakout, and that's buyable. Then it rallied a few bars. You can sell half or all, depending on whatever your trading plan and trade management calls for. Then you had the secondary retracement, which it could have been buyable the first time, but notice that it didn't trade above a prior bar's high. So even though the setup was buyable as a first retracement, mark number 2, it didn't trigger. Now, is this secondary breakout buyable based on what we just covered, and why? The answer is yes. It's very buyable, because if you look at the prior page, it had 100% retracement back to the prior high, and we are not suggesting buying that new high. It went sideways for 1, 2, 3, 4, 5, 6 bars. Now, that breakout from that 6-bar consolidation is buyable as a secondary breakout. Another example here of how a new trend originated from what we call a base. The first number 1, though, is the initial breakout. Is that one buyable over the red line? Yes or no? I'm going to talk to you a little bit. The answer is no, because the stock rallied 1, 2, 3, 4 bars. You see 4 green bars off of the middle of that base before breaking out. That is not buyable. Then it rallied some more and came back. Mark number 2. That is our first retracement, and that is very buyable. That's the first retracement to minor support after the initial breakout from a base. I know that's a mouthful there, and if you've taken the Pristine Method Part 1, you will also know that this is a quality pristine buy setup. Then the stock moved, made a new high, and you see the secondary breakout there. Is that one buyable? Answer, no, because it's extended at that time and it didn't consolidate at the prior high. So we would just be in the trail stop mode. We would hold our long, but we would not be adding to that secondary breakout. So it rallied up, we stopped out under a prior bar's low, and it's retracing again. It's retracing again to minor support. We've got our bottoming tail, we've got a rising 20-period moving average. That's also a pristine buy setup, and that's a buyable first retracement again. The next breakout, same as the other one. It's up 3 bars. I'm not buying that. I'm just in trail stop mode for my position that I just bought at number 2. Then it retraced again, so that's another first retracement. That one is buyable. Then, at the very top of the screen, is that secondary breakout buyable? Answer, no. It's up 4 bars again. See how straightforward this is? Here's the identical chart, but I'm just giving you one slide here on risk management. So you see the low risk entry, that's our first retracement from the breakout. Then you trail stop after 2 bars. Just place a stop, whatever time. This could see as I promised you that you don't know if this is a 5-minute chart or if it's a daily chart or a weekly chart. The reason being is it does not matter. The pristine method applies identically to any time frame. And does this matter if this stock is General Motors or the S&P futures? No, it doesn't matter at all. So we trail stopped after 2. We bought that next retracement on support. Trail stopped after 2. Bought the pullback. Trail stopped after 2. That's your management on those multiple breakout plays. Here's an example on both of these where, well, the one on the left was a breakout. And I had, both these, believe it or not, were in this newsletter that a friend sent me one day. He called both of these buy these breakouts. And so I have a question there for you on the top left. Would you be a buyer there over resistance or a seller into strength? Look, just count the bars from the low. It's up 1, 2, 3, 4, 5, 6, 7. 7 green bars. For those of you who have had the pristine method, and again, I want to keep emphasizing reading Greg and Oliver's book, Tools and Tactics for the Master Day Trader, because you must have the proper mindset for this business, or else you won't succeed. And logic is unfortunately not a big part of it, but it's unemotional, objective, unbiased reacting to what really matters, and understanding the bandwagon theory and fear and greed. So you will learn in the pristine method, I don't care what the news is, I don't care why this stock rallied 7 bars, but when I see 7 bars in a big fat wide range bar like this, I will be shorting you in the very near future. It's just a matter of time. So we sell into that bandwagon. We do not buy after 7 green bars. If I caught one of my traders doing that, I would literally walk over to their computer and unplug it. I've done it before. On the right, same thing. It's a bullish move. They're big wide range bar out of a base. There's some interesting advanced concepts in that chart, but it's also up 1, 2, 3, 4 bars to resistance. I would not be buying that breakout even if it occurred. Instead, I would wait for the breakout to fail, and then I would be looking to short it for a little counter trend move. Breakout from a base now. So this consolidation at the low, it's just overlapping bars, red, green, tails. That is not a quality consolidation. But, we're always picking up little nuances here. One thing that jumps out at me is the bottoming tail at the very low. So that stock did try to break down. But then, notice that bottoming tail at the dead low down there closed with a big fat green bar back at the high. So there were some bears in there that got shaken off the tree, if you will. Continue to go sideways, and I have marked there for you that wide range bar that closed at the top end of the consolidation. I'm still not buying it yet. Once it trades over that bar through resistance, then that's a breakout with a stop under the low of that big wide range bar where it shows there, stop loss. So that was buyable. Then it consolidates a little more and gives you another time to add to the breakout. Even though that's not a quality consolidation, so that one's a little more advanced, the fact that it broke out and just churned its way up without retracing was also a bullish consolidation over time. These were some pre-market breakouts. I have a DVD that I did called Market Preparation, Trading Gaps, and Trading the Open that you can also find at Pristine Trading University. And in the pre-market preparation component of that, I explain to them how I get to the market. Every day I get there 70 minutes before the opening bell. And I do that because I like having 10 minutes to get situated, and then I want to see the reaction to the 8:30 economic numbers, because I trade the pre-market futures all the time if I get a compelling pattern. So they had some economic number at 8:30, I don't know which, really don't care. But we had a bullish consolidation on both the S&P futures and the NASDAQ futures. Now the NASDAQ, you notice those dots in there? That means there's no trades, so that means it's lighter volume. So I would not have bought the NASDAQ myself, the initial one. The S&P was a little tighter, but instead, as a general rule, even though this pattern was viable, I like waiting. I like waiting 5 to 10 minutes to make sure that when I trade pre-market like this, to make sure that the breakout or breakdown is going to hold. Because many times trading within 5 to 10 minutes after an economic number, it becomes very volatile. So, is the first retracement in both of these pictures viable? The answer is yes, because you have a nice 3-bar retracement that held the upper 1/3 of that big fat wide range bar breakout. So that is very bullish retracement. You buy over a prior bar's high, stop where the star is, stop under that bottoming tail, manage in between. And notice also the volume that ignited these moves out of the breakout was very positive. Let's see how much you've learned right now in less than an hour. Let's start over time on the left, and I have marked there incorrect. Why? It's extended, but it is a breakout. It is what it is, right? That's objective. It broke out over 2 prior highs, and it's a breakout. But based on what we've gone over already, you don't buy that. It's extended. You wait for the first retracement, which we got. We have a nice 3-bar pullback, bottoming tail, into the top half of that power bar. That is the professional place to buy this stock. You buy over the high, stop under the bottoming tail. Then it broke out, came back again, consolidated kind of in a sloppy manner here. So that is not a quality consolidation, but in this case, it gapped over those tails. So that made it buyable. If it opened just flat and broke out, I wouldn't have bought that as a quality consolidation because the tails are whippy. But the gap would have allowed me to buy a 5-minute high in that particular case. Then at the very high, you see another breakout. But it was up 6-7 bars. That's an incorrect breakout. I'm looking to sell into that strength. Finally, the one marked deep retracement. Now, if you're an aggressive trader, we might trade some of these just for partial bounces, but I want to keep you on a shorter leash in this DVD to focus only on quality. So this one, the reason I'm saying deep retracement is it retraced more than 100% from the prior move from low to high. It slammed through the prior low. So that's bearish. And I don't want you buying deep retracements like that greater than 50%. And they're just some of the factors here. I put in bullets here for you. Is extended before the breakout. We've covered that. Did it consolidate in a tight range? Is there congestion to the left? Don't forget that. Remember, quality pattern. Room to run is another way of saying that. Tails, overlapping bars, and gaps. That's going to help us decide whether it's quality or not. Let's have another quiz here for you. That's, I guess, a happy bull, if you want to call it that. Let's go through all these letters here. Let's name the type of setup and whether it's viable or not. At A, that is a breakout. Now, it's not a tight quality consolidation, but I want you to notice the angle of the 20-period moving average is, wow, that's like at a 70-degree angle. So a moving average means what? Moving average is simply a squiggly line that is plotted by taking the closing price of the last 20 bars on that time frame. Once again, I don't even know what time frame this is. I really don't. And it doesn't matter. So on this time frame, it's taking the last 20 bars, dividing by 20, and plotting a squiggly line. So for it to be that vertical, there's been, even though you can't see it on this chart, by definition, to the left of this chart in time, there was some strength. So this would have been an aggressive continuation consolidation at letter A that would have been viable. At B, did that consolidate through time, or is that a viable first retracement? This one's a little tricky because it didn't come in the nice 3-bar pullback with bottoming tail like some of our other examples I showed you. And when a stock does not retrace, but instead consolidates over time, the ones that consolidate over time are in fact stronger because the profit taking and selling that occurred was absorbed by buying. And so that is what we call a consolidation over time. So this actually, you could have scalped another breakout at letter B. Now, what about at C? Is that a viable retracement as a first retracement? The question on this one, and again, that's why it really helps to, unless you get a slam dunk salivating pattern like at F&G, then it really helps to have our entire Pristine Method Part 1 and 2 under your belt. Because at letter C, the stock's getting extended. So look how far it is from the 20-period moving average. And if you did that one, it really just would have been a scalp. And as you can see, it did set up a failure right there. And if you've had our TPM Part 2, and you see that, we call that a 2-bar reversal with not much congestion underneath, and you actually could have shorted that failed breakout at C. Number D and E are those, let's do D first. Is that viable as a first retracement? So it's retraced all the way back down to support at B, where that other breakout occurred. Answer is yes. It came down fluid and held on support. Got a nice narrow green changing of the guard, we call it, which means a green bar after 3 or more red bars. And you can buy over the changing of the guard, stop under the low. At letter E, that is a retest of the low at D. So that would have been a place to add, actually. At F, and F and G, depending on the time of day and the time frame of the chart, could be construed as late day breakouts. When we get to that chapter, you'll see. But both F and G could be bought as initial breakouts. Even if you just turned on your computer after lunch and you're a late day, or you're just a breakout specialist, and you saw that bullish consolidation at F and at G into the rising 20, after earlier strength all the way from A, those are definitely buyable. And there's some patterns that I call them pounding patterns. Right there at G, I would have pounded that thing. And in my advanced lab, I'll even teach you how we try to create these breakouts when we time them with the market internals. Letter H is that a buyable first retracement by the definitions that we've just been going over? Answer, yes, but caveat. The deep retracement suggests that it's not going to make a new high. So it is buyable, and we would just generally look for about a half retracement and just go into trail stop mode is all. So nice job. Hope you did well on that quiz. Pristine breakout to a new uptrend. Both these are two different stocks, and both of them were in very bearish downtrends. We do not buy falling knives. Instead, we wait for some type of bullish retest. Let's start with the one on the left. So it came down. We would not have bought that first, we call this a double bottom. We would not have bought the first bottom at all. It then moved up, had a nice retracement, and then came back to test that prior low. Now, beyond the scope of this course, but you could have, we teach in Pristine Method Part 1 when you can buy the initial retest of that prior low, and we actually call that transition A when it's an anticipated break to a new uptrend. But in this case, we weren't buying the first changing of the guard. And in this case, it actually went sideways, building support at that prior low. So you could have bought where I marked buy from the breakout of that 4-bar consolidation on support. Pristine Chairman Oliver Velez would describe this as, if I'm wrong, because bear in mind our stop's under that green support line. If I'm wrong, he says, I'm falling out of the basement floor, the basement window. I'm not going to get hurt. So the reward to risk on these plays is high. So what about when it takes out that prior high? Is that buyable as a secondary breakout? Yes or no? Answer, no. It's extended. But even though it's extended, we would then look to buy the next retracement. So I'd be looking for a controlled 2 to 3 to 4 bar pullback, and then I trade over a prior bar's high. The one on the right now is also a type of retest after a downtrend, but this one occurred from a gap. So notice that it did close with a retest at the prior low, but it didn't trade over a prior bar's high. So even if you've had our other courses, you would not have bought that stock because it didn't trade over prior bar's high. But I'm guessing this is a new day because of the gap. You rarely get big intraday gaps like this. So the next day it gapped up over the prior high. Then I have red bar, red bar, red bar, red bar, gap fill, higher low, then it trades over the prior bar's high. Where is my congestion or resistance to the left? It's all the way back up near that gap fill. So again, my reward to risk on this trade is like 10 to 1. That is very buyable on the retest into that gap as an anticipated break to a new uptrend. I'm showing you how you can use multiple time frames to increase the odds of a breakout. Let's start with the daily on the left. This is a consolidation, sloppy one. See how you have some tails, but notice that the lows are getting higher in the horizontal resistance line. So this is what classical technicians call an ascending triangle. when the lows are higher like that, that means demand is building. So once the people selling the stock at that horizontal trend line are done selling, there's nothing for the stock to do except go up, because then demand overwhelms supply. So you could have traded that off that chart alone. But when we have multiple time frames in agreement, then that makes the odds of success even higher, and then it might give us a bigger target. Let's look at the weekly chart on the bottom right. This is also what another classical pattern that classical technicians would call a reverse head and shoulders. You have the left shoulder that I have marked as an S, and then it made a new low, and that's your head. It rallied back up to the prior congestion area, the shoulder, and went sideways. So that sideways consolidation has the effect of eating up that supply to the left. So once that breaks out, notice on the weekly chart, there's no congestion to the left. So it was a weekly breakout also. So I have a breakout on the daily, breakout on the weekly, higher odds. And I just threw the monthly on here to show you that this could have been actually a core trade. We define core trade as a holding period from weeks to months. So in our, this is actually a failed breakdown on the monthly. Notice a big ugly red bar broke down from a consolidation of 7 ugly red bars, or 7 consolidation bars, in the lower half of the prior ugly red bar. So that was shortable. And I have another chapter coming up where I'm going to show you how you can capitalize on failed breakouts and breakdowns. Now, prudent, pristine traders also have to be able to change their opinion on a dime. So this could have been an example where if we were core short this particular stock, and I don't know what it is, it would have been okay to add to that core short where it broke down on the monthly chart. But when the very next bar engulfed that red bar, that's bullish. So you have to be able to change your opinion. And I could have very well, myself, and advised our trading room, you know what? Cut it loose and reverse your short position and go core long once it breaks out. So all 3 of these time frames were very bullish. These are the scans that I told you I run to look for various breakouts in pristine ESP. In the swing trading module, there's one strategy called narrow range 7 setup. ESP is looking for the narrowest range of the most current bar, swing trading, so daily bar, of the last 7. And so even though it doesn't have a trend, a presupposition, many times you find tight consolidations that are poised for a breakout or breakdown. Daily above average up-down volume. For you to have some big volume spike on the daily, something's up with that stock, and it could be breaking up or down. In the gorilla trading mode, Pristine calls gorilla trades the 1 to 2 day hit and run tactics that I mentioned earlier. We teach 12 of them in Pristine Method Part 1. These are some of the ones that I look at every day, looking for miscellaneous gorilla and breakout breakdown setups. The 10-10 buy and sell setups, where ESP is looking for multiple bars in a row with big fat red or green bars, wide range up or down, and bullish and bearish engulfing. Micro trading. So for just the intraday day trader, this is all you have to be worried about, is these bottom 2 modules. In the micro module, 15-minute basing in the top 2% of the day's range. Another one called gap up and strong, gap down and strong, and the 30-minute gap buy for breakouts and 30-minute gap sell for breakdowns. And on ESP, you can actually you can open these individual modules and just leave them open, and they will populate for you every 60 seconds. And all you do is when something gets populated, you left-click it and you look at multiple time frames, and you see if that's a quality pattern meeting the descriptions that we're talking about today. Enter appropriate share size, manage in between. It's that simple. In the basic trading module, I keep these up every day also. The above average up-down volume, 52-week highs lows, top 20% gainers losers, and 1-month highs. Again, every single pristine scan that we have, all it does is it's our little Merlin just working nonstop to bring you tradable ideas in accordance with the scans that you have highlighted for it. So it does not mean, hey, if I have a 52-week high, buy it. If so, I'll be coming to your house to unplug your computer if you aren't following the rules as we're talking about in this DVD. Here's an example of a 30-minute gap buy from Pristine ESP. So the stock gapped up, and hopefully you will notice from our earlier discussion, it gapped up from a bullish consolidation into the close. So that provides a base of support. Then, this is a 15-minute chart, so the first bar was very strong, and then it based at the high on this 15-minute chart for, it looks like, an hour and a half, and then it triggered, and there at 11:09 a.m. in 3 seconds, and the 30-minute gap buy is when it had a bullish gap and traded over the 30-minute high. So we would pull it up. The stock happened to be ARM. ARM was the symbol, and we pounded it. That's a quality pattern. Now we're ready to talk about the 3 breakdown types. Just like the other one, this graph looks similar. We have the initial breakdown under major support, under quality consolidation. I have marked here as number 1. Then the stock retraces back up towards that breakdown area, which we call minor resistance, and that's our first retracement, which is the safest entry to enter this short. The secondary breakdown, similar to the secondary breakout we talked about, we only want to short these if it's consolidated at that prior low first and not being extended. Here we got a happy bear singing, and let's see what kind of entries here on the initial breakdown, retracement, and secondary. At the very top, you can notice that it had a failed breakout, then deep retracement back to the prior low. It didn't bounce, and instead it consolidated for 6 bars near that prior low. That's an initial breakdown that we would be shorting aggressively. Then this one was a consolidation, and this one's a small little secondary retracement that you could have shorted under that bar. And then secondly, as a secondary breakdown, that was shortable also because of the 5-bar consolidation at the lower end of the initial breakdown bar. Then the stock dropped beautifully, rallied 3 bars, topping tail, and that's another place to short what we call the first retracement. Then it went sideways for about 10 bars again, and you could have shorted that again as an initial and secondary breakdown. Brand new trade. Doesn't matter what you call it. It's a quality breakdown from a consolidation. Fell a couple bars, retraced again to minor resistance. We have another secondary retracement. First retracement to short into. And on number 3 at the very bottom, is that a secondary breakdown that we would short? Quick, easy answer, no, because it's down 3 bars to support. and it didn't consolidate at the prior low like the preceding ones did. But then it rallied back to the resistance area, and once again, that was a retracement that you could have shorted. Here's Pristine ESP scan in the morning. We found this one under pre-market gap below prior low. I'll discuss this a little bit more when we talk about breakouts from gaps. And additionally, as a side note, in my DVD called Market Prep, Trading Gaps and Trading the Open, we have a whole chapter teaching you how to trade gaps that is very thorough, which I have a number of traders that specialize in trading gaps. In the morning, the first hour, all they do is focus on gap plays. Then they shut their computer down and do what other fun stuff they want to do the rest of the day. So this one had a very bearish gap on the daily, on the right side of the chart. On the left, you can see where stock opened on the 5-minute chart, and it gapped under all of that consolidation into the close. So all of the bulls that went home happy are now sad, because every single bull in that daily big green bar is now holding a losing position. So the first 5-minute bar is red. So in that case, we say it's okay to short the first 5-minute low. So that we would have shorted, and then we had the first retracement, which was shortable. Then it retraced back to the prior low, and it didn't bounce. Instead, it went sideways for 3 bars. So could you have added that as a secondary breakdown is the question. In this case, even though it didn't consolidate for more than 5 bars, the fact that it's bearish on multiple time frames, had a deep retracement to the prior low, tried to bounce and couldn't. Notice the one green bar is buyers. So buyers stepped up at a prior low trying to pick a bottom. But then after 3 bars later, it couldn't go anywhere. Not only do you have new short sellers like me, but all the bulls who bought in those 3 bars are also selling. And that's what creates the secondary breakdown in that case. Here on the left, we had a lot of happy bulls that went home in that green bar that were happy. And I have a picture of this bull in a cage because this bull, all the bulls in that green bar are trapped. So we teach, as I mentioned, 12 guerrilla strategies in Trading the Pristine Method Part 1. This is one that we would call a bull trap because of what I just mentioned. So we have a bearish daily. So now let's look at my intraday chart to see if I can use a breakdown strategy to get on board. The answer is yes. Look on your 5-minute chart or a 15-minute chart in this example. It had a very bearish gap at the open, so all of that bullish consolidation into the close becomes resistance. First bar is red on the 15-minute chart, and then it consolidates for another 1, 2, 3, 4, 5, 6 bars without taking out the day's high. You short the low, stop the day's high, manage in between. Another example of a couple breakdowns here. The initial breakdown was shortable. You had a failed breakout at the high. You have a declining 20-period moving average. You had 4 consolidation bars that couldn't bounce. You short the low, stop over the consolidation, manage in between. Now look at this. This is what we call a quality downtrend. The selling is relentless. There's not hardly a green bar to be seen anywhere. And if there is one green bar, it's just engulfed the very next bar. So you could have shorted that initial breakdown. Then you could have shorted the retracement as shown there. And then at the very low, we had a gap and a big wide range green bar. So that is telling us that the pain is over, something's changed, and then we would have stopped out of our short and then actually ride this thing back up. And you could have bought that first retracement in where it's marked right there. Here's just an example of a classical pattern. This one's called a bear flag, and it's a bear flag breakdown. So we're just giving you different flavors of breakdowns. So a bear flag is a classical pattern where you have a rising channel trend consolidation. So it's a price bounded by two parallel trend lines against the prevailing trend, which in this case was down. And once it breaks the lower trend line, then that's your entry. Volume's typically lighter because it's a consolidation. So you short under the trend line, stop over it, and the implied measurement is you take the distance from the very high to the top of the channel, and you project that from where it breaks the lower channel trend line, and you project that down, as you can see by the up and down dotted lines. I reviewed for you in the last chapter a reverse head and shoulders. Now this is a regular head and shoulders. And you can see on the left shoulder, the left and right shoulders are opposite the head that's in the middle. So in essence, it's almost like a shakeout, because the stock consolidated on the left shoulder, broke out to new highs, and then had a deep 100% retracement and went sideways. Once it breaks that horizontal support trend line, that's called the neckline, and that's when you short the breakdown right there on expanding volume. The implied measurement is you take that neckline, project it up to the head, you project that down. And in this case, the projected, it's just called an implied measurement, corresponds with the actual congestion area, and that's when they make sense to the pristine trader. Everything has to be in alignment with actual congestion. Wow, this has a lot of stuff on it. Let's see how much you've learned already. Number A, you had a false breakout and 7 bars. So even though that's not what we call a quality consolidation, the fact that you had that big fat green bar and then it failed, you can short under the low of those 7 bars. At letter B, so A would be called the initial breakdown. And then it held to the prior low and bounced. So at letter B is our initial first retracement to short into. Then it broke down again at C, so that would be called the secondary breakdown. Rallied up to D, that would be the retracement. Then at letter E, we would not short that. Why? Because it's extended and didn't consolidate at the prior low. Then at letter E is our retracement to short into. At letter G, it is a breakdown, but it didn't consolidate at the prior low, so we would not have shorted that one. At letter H, that was a retracement to minor resistance and topping tails, and guess what? That was a quality one to short, because it did trigger. See at letter H, it did trade under the prior bar's low, and then it gapped up the next day. So unless you happen to be stopped out in the first day, it's tough to tell because of the tail there. You don't know when you entered. Guess what? That's part of life, of trading life. Not all trades are going to work. So if you held this short overnight, you got stopped out the next day when it went against you. At letter I, that is a retracement, but that's one that we would not take because the retracement was too deep and went over a prior high. Notice how it went over letter F. So even though it worked out, we wouldn't have taken it. We can't be a Monday morning quarterback. We're here to trade high odds patterns. At letter J, would we have shorted that secondary breakdown? Absolutely not. Because it's down, 10 red bars in a row. That would be one that I would actually be looking for a failed breakdown to get a little scalp to the upside, which did happen. You had 2 beautiful green bars. Then at letter K is your retracement to short into. Would I have shorted the low of letter L as a secondary breakdown? Absolutely not. It's extended 3 bars down. But then it went sideways for 5 bars and made a new low at letter M. That one I would pound. That's a beautiful breakdown consolidation, shallow retracement, topping tails. That one was great. So good job. I'm sure you all did well on that quiz. Now, one of my favorites, talking about breakouts and breakdowns after you have a big, fat, wide range bar. Many breakouts fail just because it may not be a quality consolidation, because you might have other traders fading it, selling into it, many reasons. So particularly in sloppy consolidations, I'm going to give you a very simple rule to keep you out of trouble most of the time. And here it is. We want this wide range bar to close outside of the consolidation, because then the indecision in the consolidation is now resolved in favor of the wide range bar. If it's green, bulls. If it's red, bears. And then your stop is under the consolidation if long, or over the consolidation if you are short. These are multiple time frames, same stock. So notice on the daily and the hourly, the breakout occurred at the same time. So here's another multiple time frame where you had bullish consolidation, you have a strong uptrend, you got rising 20, rising 40 period moving average, and it breaks through resistance. So that initial pullback was viable, stopping at a low. Now on the 15-minute chart, because the daily and hourly were so strong, let's say you missed the initial one. Let's say you just missed the morning breakout. You could have added and or taken your initial lot in that 15-minute retracement into the wide range bar as a brand new trade and or to add, and then you just go back to the daily time frame to manage, because that's a beautiful swing breakout. Now we have a pristine breakdown after a bearish wide range bar. So starting on the top left, we have this ugly wide range bar. Then we have 10 sideways bars at the lower end of that wide range bar. Think, folks, just think about what's happening. And again, I don't know what time frame, and it doesn't matter. 5-minute chart or a weekly chart, doesn't matter. So the bears were in control. Look at my little bear there eating the bull for lunch. He's in total control of that first ugly red bar. And as you know, every single transaction that every print you see on the tape is both a buyer and a seller. And that's fair market value. So these 10 bars at the lower end of this ugly red bar, they're all buyers and sellers. So you only bought for one reason, because you thought the stock was going to go higher. So all of the buyers or bulls in that 10-bar consolidation, we teach that patterns are thought patterns also. So that bearish consolidation, if you were a bull in that consolidation, every bar that goes by and it's not bouncing, you are losing confidence in your bullish position. So once all of these bulls have had enough in the consolidation and they say, heck with this noise, and they sell to close their position, and then again you have people like me and other pristine trained traders that recognize this pattern, hopefully you now after viewing this DVD, we are going to add to their pain, provided they don't stop out, and we are going to short to open this initial breakdown. So we have people like me selling to open. We have the longs, the bulls, selling to close. And what happens is you have selling, overwhelming, buying, and the bottom falls out. So that was short the initial breakdown, stop over the high, and get ready to eat that bull for lunch. Then we had our bounce. You can short the retracement. We had then a big sideways consolidation, but we had a bearish consolidation at the low. After a false breakout, I would be shorting that new breakdown again, stop over that sideways consolidation. Now I have a singing bear. Starting at the top. First of all, let's answer the question. What do these tails tell us? Particularly after the big wide range bar from the base. A tail is, we call it a topping tail. So think to yourself what the bar looked like at its most bullish time of the bar's life. Again, whether a 5-minute chart or a daily chart, it doesn't matter. At the high of the bar's life, it was a bullish green bar. The bulls were in control. At the end of the bar's life, they are red bars with tails on them. So by definition, that topping tail represents sellers. So while the bar was being formed and the bulls and bears are whacking at each other, bulls won, bears won, but at the end of the bar, the bears won the bar. So those are bearish tails. And those tails are lower highs from the highest high in this chart. Now my horizontal trend line, same story as the other slide, consolidation at the low, another false breakout. These bulls are going to get tired. And then you have people like me, the bear. I'm going to be singing along with this bear. And I'm going to short the breakdown. Stop over the prior tail. There's no congestion to the left. So that means my reward to risk is huge. When people say, oh, trading's risky and so forth, that just tells me they don't understand it. Because I always approach a trade before I enter. I don't ask how much joy is this trade going to bring me. I ask, if I engage in this, how badly can it hurt me? So that's a different little psychological twist. I mean, it's obviously a compelling pattern, but I also am focused more on risk management. And I say, yeah, compelling pattern and so forth, but that's why I won't hold over earnings or some kind of unknown news event, because then you're just gambling. Last question. What does this consolidation imply after this breakdown? You are correct. It implies bearish consolidation because from the breakdown area, it had one green bar, which is bottom fishers, buyers saying, oh, it's down 7 red bars. It must bounce right now. And then the fact that it had one green bar, weak bounce, it's ready for another leg down. This is, I want to show you the risk of buying many times, particularly in a sloppy consolidation, as I mentioned to you, before the bar is complete. So I just gave you a little introduction of this in the last two slides when I said how did the bar look like at its most bullish time. So this just illustrates it a little bit more clearly for you. So let's start with the stick man down here. So at A, at the high of the day, the bulls were happy bulls, while the bar at its most bullish time. But if it closed like B, they're now unhappy bulls. So now on the right side is an example of this. You had a consolidation, but you know from our introduction that that is a sloppy consolidation. Why? Tails, gaps, overlapping bars, wide range bodies, narrow. That is an absolute mess that, yes, I would unplug your computer if I saw you buying that breakout. So at the high of that breakout, you had some happy bulls. They said, oh, okay, I know Gibby would yell at me because it was unhappy, it was a sloppy consolidation, but I'm going to get the last laugh because, look, I'm in positive mode right now. And then the very next bar, who got the last laugh? You're now an unhappy bull saying, darn it, Gibby was right again. I just jumped the gun. I didn't wait for the bar to complete itself, and now I got to stop out. This is actually in our advanced course, the Trading the Pristine Method Part 2. This is called a shakeout, and you know, we have a whole section on failed patterns that are some of my absolute favorites. I see things like this that sucks in the public, and then I look for signs of failure, and provided there's no congestion or support to the left, as in this case, I'll short it. I'll short the breakdown and add pain to the unhappy bull who didn't take his or her stop. Now, this is the proper way. So that you want to either trade against the trend or from a sloppy consolidation. All right, so those are your two rules that if you follow this, I promise you, I will take away like 70% of your losses if you follow this. On the left, we had a downtrend, sideways consolidation. I don't know if this is going to break up or down. So you wait for the big fat green wide range bar to close above the consolidation. So now the indecision is resolved to the upside. This could have easily broken down and it'd be ready for breakdown part 2 in some of the examples I just showed you. Likewise on the right, it's in an uptrend. So if you're going to trade against the trend or from sloppy consolidation, wait for that wide range red bar to close below support. Then stop is over the base, and like every single trade, remember, you need no congestion in the way for it to try to reach your target, so you have a nice 3-to-1 reward to risk. And this one, sideways consolidation, wide range bar outside of the base. Now this one was fairly tight where you could have bought the initial breakout. But let's say you missed it and you say, wow, I have a wide range bar out of a base. So Gibby said that's strong and I could buy over the high of the wide range bar. Or many times you get what we call an inside bar to the wide range bar, and provided it's a bullish inside bar where it doesn't retrace more than a third into the green bar, you just buy over the high of those two bars. No congestion to the left. It's out of a base. This is starting a brand new move to the upside on this time frame. Because it's getting extended, you would just go into trail stop mode. And then you actually got a novice gap up one day. This is an hourly chart, I can tell, just the vertical lines. So this one actually gapped up. So it was a 2-day trade, and you sold on the third, and it was a home run play. Now, do you see this is the daily chart on the left and the 5-minute on the right. So do you see this daily is a mess. And so I purposely don't just cherry pick charts to show you because that's not realistic. So but what we're doing instead is showing you how to objectively trade the financial markets under the Pristine method using technical analysis and market internals and sentiment. So I wouldn't touch this pattern until that indecision is settled when you had the wide range bar close over the consolidation resistance. Then I'm not buying the initial breakout. I'm letting it close. Then the next day was one of these bullish inside days that I mentioned. You would buy over the high of those two bars with a stop under the wide range bar. It doesn't even have to be under the base. And this, when you're trading these wide range bars out of a base, if it then fails the breakout and trades back under the wide range bar, then that was another failed breakout, and I would just dump it. There's no resistance or congestion to the left until where I have the target, and the reward to risk was huge again. I'm showing you this 5-minute chart, though, to same stock, to ask you, could you buy the afternoon breakout? The answer, you better believe it. Applying what we learned before. It was up on the day, bullish consolidation into the 20, and that was a breakout on a smaller time frame, and then you're just going back to the daily chart for your management. Here, a big assuming it's a daily chart, multi-week consolidation. We have the trend lines coming down. We have higher lows, though, so it's suggesting, when you get these apexes like this, it's suggesting a breakout up or down. So we are waiting to see who's going to control. You know, the market to us is like this big whale swimming around in the ocean that's influenced by world issues. You know, the bond market, currency market, macroeconomics, what the Fed's doing, what technicians are doing, what hedge funds are doing. So we don't care where the whale swims, unless you're JP Morgan or have unlimited capital like that, where you can deploy enough buying and selling supplier demand to move the markets yourself. Don't try to change that whale. Instead, we're just using our charts to figure out where we think the whale is going in that time frame. So in this case, once we had that wide range bar that closed through that resistance, we say, aha, the whale, the bull in this case, looks like he wants to swim uptown north. And so then we had another inside bar, and you would buy over the high of the wide range bar in this case. Stop under the low of the wide range bar. Here we have a happy bear again. Let's see what he's doing. We had at the very top, we had an initial breakdown, but is that one that we would have taken? Answer, no, because it was already down 3 bars to support. Then it gapped down and had a bearish multi-week consolidation, or multi-bar consolidation at support. Then we had but it was a sloppy consolidation. So we had a wide range bar that closed under that horizontal support line. Now this becomes a tier 1 focus play for me. The very next bar was one of these bearish inside consolidation bars, and so we would short under the low of those 2 bars, stop over the high of the prior breakdown bar, and so that's our stop. And where's our target? Well, if you look on the left side of this screen, Remember I showed you earlier about fluid moves going up, and there's no congestion because of that fluid move up. So when you have no congestion to the left like that in a bearish breakdown from this multi-bar consolidation, my target is all the way back down to where the 20-period moving average is, where this thing broke out in the first place. So the reward to risk, again on this play, is at least like 5 to 1. Here we had an ugly red bar on the daily chart that engulfed all of that mess. So again, we don't know whether before that ugly red bar, we didn't know if this thing was going to go up or down. It's a mess. But once you have the big ugly red bar, then we had an inside bar on support. Once this trades under the low, there's no congestion. The bottom should just fall out of it. And I showed you on the hourly chart here that little topping tail provided a beautiful double top for your stop. So you shorted the breakdown on both the hourly and the daily chart. It was the same number, and our stop in this case was over the topping tail bar. Another happy bear here on this breakdown. Starting at the top where we say buy setup failed. That was, we had bulls buying in there. We had a big move off the low to the prior highs. 1 red bar, 2, 3, 4 red bars, bottoming tail, green bar. You had bulls in there. Then the very next bar, it closed with a topping tail, and it should have gone farther. Then you had an ugly wide range bar down, stopping out all the bulls who bought that particular pattern. And then, now I need to deploy what we're learning in this seminar, and I need to start getting on board. So you had the initial wide range bar breakdown. Then I had my first retracement into that wide range bar is shortable, stop over the tail, the high. Then, what does all this bearish consolidation tell you for the next 10 bars? It couldn't retrace. Green bars didn't go anywhere. It's all on the horizontal line. Then I had another wide range bar that closed under the consolidation. Then I had another inside bar. Folks, I tell you, when I see patterns like this, and remember in our slide about successful trader matrix and what does it take to be successful, do you remember compelling pattern, have a method, time frame, instruments, and then the last one was patience and discipline to follow your method? When I see patterns like this, and if we could get people to, and that's what our labs do. Our Pristine method, we have part 1 and part 2 is the advanced lab, and they're solely designed to help you integrate this theory into practice. People leave our seminars ecstatic, and they just want to rush Monday morning and start pounding on the mouse to get into trades to illustrate the new breadth of knowledge that we've just bestowed on them. But then the market opens and all the lights are flashing, and they freeze up. They're like, I just forgot everything I just learned over the last 2 days. And so our labs are meant to help implement what you've learned, to develop your own trading style, your own trading routine, to look for these patterns and then to enter them and share size and manage them per your style. And we show you that high probability patterns have tremendous success, like this one. So when I see something like this, I need to put saran wrap on my keyboard because I want to salivate, and I would try to create this breakdown, particularly with bigger time frames confirming and market internals confirming and etc., other things that we teach, because I also believe in the 80-20 principle in trading, which means I think you're going to make 80% of your money in 20% of the time. The market is not a casino. It's not a bank. It's not something you just walk up to every day and say, "Where's my paycheck?" It doesn't work that way. We have to strike when the odds are in our favor. I remember reading the book on George Soros. And when I first, one comment that first I totally disagreed with, and I think because it was early in my trading career, and now subsequently I've been trading full-time 9 years with over 60,000 trades under my belt. My confidence level is just unshakable. He said a comment like, "It takes guts to be a pig." And when I first was thinking about that, I said, that is totally wrong. You can't be a pig. The market doesn't owe you anything. You need to, go for singles. But then what I learned later on through my maturation process was this pattern. For example, when you see things unusually lining up where you're expecting a big move, whether it's in an individual instrument or the broader markets, then that's when it's time to raise the stakes, but we're doing it intelligently. And I call it pushing the throttle. This, hopefully you'll be watching this DVD for the next 20 years. There, in our advanced trading room, a few months ago, when the market had a false breakout, we were pushing the throttle, and we had just an incredible record. In 3 weeks, we booked over 450 points. It was just mind-boggling the amount of successful trades we had, and it's because everything was in alignment, and we just pushed very, very aggressively. So anyway, I apologize for that little detour, but just these patterns, they get me excited like this, and this is one that I would be pounding on. I would short under the low of these two bars after that, and there's a lot you may not understand my joy with this pattern, but trust me, once you take the Pristine Method Part 1 and 2 and get some experience, come back and you'll say, "Oh yeah, look at all these other things that are in this chart that were beyond the scope of this DVD." Now we have a happy bull here. We had a consolidation on the daily, nothing to do. But before the breakout, notice the big fat green bar back up at the highs. All of the preceding 10 to 15 bars close with tails and weak bodies, so that one most recent green bar says, maybe it's ready for a breakout. Now on the 15-minute chart, into the close, so you can see where I have the star. The stars were how the stock closed. The 15-minute chart had a very, very aggressive run off the day's low, deep into that prior resistance. And what did it do? It consolidated through time. It did not consolidate through price, which, as you know, means a pullback, a retracement through price. So this consolidated through time, broke out into the close, and there's my wide range bar through the base on the 15-minute chart. So the very next day, we simply bought over the high and stopped under the prior day's low, and we managed it off the daily chart because it was a breakout from a multi-week consolidation. Now, in this chapter, we're going to talk about breakouts from gaps. And as I mentioned to you again, we have an entire beautiful gap chapter in my Market Prep and Trading the Open DVD. So this is actually going to be an abbreviated portion of that, but focusing more just on the breakouts, whereas that DVD talks about trading gaps in all kinds of shapes and colors and flavors. First, I need to give you some definitions here. Pristine calls a pro gap, or professional gap, if you will, one that ignites a new move up or down. The one on the right is, again, one of my salivating most favorites. And, you know, one thing I do in my advanced labs for the students also to help them coordinate the textbook with their brain, with their own trading plan, is I make them draw for me. I make them draw their 5 most compelling patterns that they would want to salivate if they saw it, and I'll grade it. This is one of mine. Beautiful move, bullish consolidation, closed with a red bar, as you can see in this example, then gaps just over the multi-week consolidation, negating that ugly red bar with no congestion to the left. It's party time. Novice gap is one in the same direction of an already extended move. So stocks up 4, 5, 6, 7, 8, 9 bars, then gaps up. Most likely on good news, blowout earnings, you know, who knows, maybe 5 broker upgrades, and that's where we typically fade those moves. I'm looking to short it because a gap like that, simple analogy is like the last rocket booster on the rocket being ignited. There's nothing left to propel it any further. And I have another DVD at Pristine Trading University called Precision Trading on Company News, where I give a plethora of wonderful examples of how we intelligently use, I'm giving like 15 different news category items, whether from earnings to stock splits to layoffs to management changes. It doesn't matter the source of the news. And how the price reacts to that dictates whether we trade with or against it, including competitors and other affected companies. So I highly recommend you really look at every single DVD that Pristine produces. Every one is just absolute top quality. Continuation gap. It's one that continues a move, typically at halfway points, and then there's just other catch-all. It could be a bullish or bearish gap that doesn't necessarily fit one of these little caveated titles. Now here's my checklist for you, just like a good pilot would. We use different checklists depending on what we're doing. I have a pre-trade checklist. We have quality checklists. We have pattern checklists. This one's going to be a checklist or questions before you enter a gap trade. First of all, does the gap create a compelling breakout or breakdown? You have to ask, where is the next congestion area? Remember, you need enough reward to the next congestion to meet and to satisfy the target. To satisfy your stop. You have 3 to 1, as I mentioned here. Did it gap from a consolidation, what we've been talking about, or has it already moved up and then is gapping? Is the gap too excessive to invalidate a favorable reward to risk? I'll give you some tips on that. Then, after it gaps up, does it set up a compelling intraday pattern? If so, you enter appropriate share size and you manage it per your trading plan. Here's another salivating pattern. So this stock, lower highs, consolidating in a very bearish manner at the prior lows after making a new low on support. There's no congestion or support to the left. This stock gaps just under the bearish consolidation, and this one is a daily chart, and notice that there's no tail on the daily bar. So that means that the stock gapped down and couldn't bounce, or else there would be a small tail there. So this stock gapped down, the selling started, stop orders got hit, people like me coming in to short to open, and the stock collapses. So in this case, we generally don't recommend trading in the first 5 minutes, period. So you could short a 5-minute low, stop over the consolidation, manage in between. Here's a breakout play caused by a gap. That's what all these are going to be in this chapter, naturally. So what is the pattern? It is a breakout over an ugly red bar. So remember, I had a picture of the bull in the cage. He was trapped. You can envision a bear in a cage on this picture, because all the bears who went home in the red bar preceding the gap went down to the local saloon and they were high-fiving each other to all their friends because of what a great short pattern they got into. And you know what? It was not a bad short pattern to hold that stock overnight. But as I mentioned earlier, we have to, not every trade works. We never know what's going to happen next. Things can always gap either with you or against you. That's part of trading life. But most importantly, you have to objectively follow the rules. So if you were in this short, you have to know, oh my God, this thing, I got a disaster gap, we call them, on my hands that I have to manage and just limit my loss and get out of this. And then possibly even view it as new opportunity and enter it long. So if you were short 1,000, you might end up buying 2,000 shares to cover your short and to go long. I do that all the time. So the bullish pattern is, yes, a breakout over an ugly red bar. Distance to next resistance is far, the prior high. Did it gap from consolidation? Well, in this case, I'd have to say no, that's really not consolidation, but it has the same effect because that 3 bar is now support and it trapping all those bears, it's having the same effect of gapping from consolidation. Is the gap too excessive relative to my reward to risk? No. It's just it's a visual thing, and that's another reason why I take price off the charts when I'm educating like this. I don't care if this is a $10 stock or a $90 stock, because all that would do is affect my share size differently. In this case, the size of the bar, I view them as inches. So let's say that red bar is an inch or $1, whatever is good for you. It gapped up less than, about half an inch. So if I have 5 inches of target and a half-inch stop, that's a big target. The price of a stock, as I said, just affects share size. Bullish intraday pattern, I can tell, opposite of the last slide, that there's no bottoming tail here, which means it gapped up and went. If there was a bottoming tail, that would have been a small little sell-off. So all of the questions were answered in this to the affirmative. This one now, it was a multi-week consolidation on the daily, but there was no compelling reason to enter this whatsoever until the gap up. So what are our questions here? What is the compelling pattern? Gap over resistance from multi-week consolidation. Distance to next resistance, far away. I can't even see it on this chart. Is the reward to risk there? Absolutely. That's very high, so the gap was not excessive. Do I have a bullish intraday pattern? Well, let's look at our 5-minute chart. As a general rule, if I have the first 5-minute bar is green, then you can buy the 5-minute high and then stop as shown under the prior consolidation. Worked beautifully, went up, sideways. You could have even added that as an additional play, add on that breakout. 2 examples here. The one on the left gapped deep over that prior pivot. So this one did have a little tail. So notice in all of this consolidation, though, it's a daily chart, it's a mess. The bulls and bears are whacking each other in this channel. Not until this gap up did the indecision become resolved by the bulls, and it proceeded to move upwards. So that tail in this case would have allowed you to buy a small little retracement on the intraday charts. Next one, pro gap here over this consolidation, multi-week consolidation. There's no tail, so you buy a 5-minute high in this case. There's no congestion to the left. Multiple time frame example. The daily chart gapped over resistance. After, now see, this gave you a first retracement and then back up, and it started to go sideways at the prior high. But in this case, it wasn't a fluid breakout through the high, it was a gap breakout. Again, the purpose of this chapter. And just showing you the bigger time frames shows you that this could have been igniting a brand new move, that you could have held this stock for weeks to months. So notice on the weekly chart just under, it's also a breakout play on the weekly. On the monthly chart, what did you learn in the last chapter? Wide range bar from a base, inside bar in the breakout on the monthly was also a breakout on the daily and weekly. Would this be a salivating pattern to me? Better believe it. Here we have two dailies out of multi-week consolidations. Just more examples. It's a pro gap from a big mess. No tail, buy a 5-minute high. This one was in a downtrend, messy consolidation, and this is a good example where you could actually trade this up or down. Just wait for the whale to decide, am I jigging left or jigging right? There's no congestion, so it's a valid play either direction. This one wanted to swim to the north with the bulls. So it had a pro gap, and then I got my pullback into the gap fill. As a general rule, we don't want these gaps to go more than 50% into the gap, because then the bulls didn't step up as quickly as they should have, as suggested by the bullish gap on the daily. And in this case, it came in. You could have bought over a prior bar's high, and even add on that small little breakout there, that little 3-bar consolidation. Daily chart, this one gapped over consolidation. 5-minute chart, first bar was green. You could have bought a 5-minute high. Then it just churned for a couple more bars. You could have added over the high of those 4 or 5 bars. That's when we talk about adding, that's scaling in. And so let me just clarify. You know how there's some idiotic pundits on Wall Street, they make reference to, well, if you liked something, take Enron for example. Enron was a Fortune 10 company that went from I think $90 down to 25 cents in 14 months. And if it were a Fortune 10 company, you know that there were analysts just pumping it the whole way down. And I guarantee some were saying, well, Mr. Smith, if you liked it at 80, you got to like it at 70. And then he'll call you up when it's, well, I think you should average in and get some more at 60 because it lowers your cost basis, and add more at 50 and 40 and 30 and 20 and 10. And Mr. Smith, you can get some now at 30 cents, believe it or not. And then your average cost basis is now only $48. That is the penultimate naivety of approach to the market to the pristine trader. The professional approach is scaling in, and when we say we want to add to a position, that means it is an independently quality time to build a position in it. Many times we might say, you know what, it's a 5-minute high right here, but there could be some other reason where all the stars are not in alignment, so we don't want to get our full position. Where, let's say it's 3,000 shares. I don't want to take all 3,000 at once, so I just take 1,000. Over the 20-minute high, I'm going to take another 1,000, and then I might let it go up and then pull back. I'll take my third 1,000. But that all depends on the setup and the market conditions. But the point is, it's intelligent scaling in and out. Some breakouts and breakdowns. The first one here is a breakdown because it went sideways for 6 bars without bouncing. Short the low, stop over the tail. Then I have a wide range bar off the low after making a new low. So that's big warning lights going off that the downtrend might be coming to an end. It had a big deep retracement, so I would buy the first pullback. Then switching over to the right, I had a same wide range bar off of what we call major support, because that's the prior low where buyers stepped up, and also the source of the prior wide range bar. So that's bullish. Those are where the bulls said, at this price, I want to buy this particular instrument. So on the right here again, it was in a sideways mess, nothing to do, no breakout or anything, until you have the 2 rules that we've gone over already from sloppy consolidations. One is wide range bar that closes through it, or now number 2, gaps over it, provided you have sufficient reward to risk. This one gapped just over it, and as you can tell, it's a daily chart. There's no bottoming tail on that bar, so we'd buy a 5-minute high. Target is what? Congestion. And so it met it in 2 days. Nice trade. Here's my bull trapped again. He's in jail. Hunter's got him. And this is another salivating pattern. Daily chart on the left is in a downtrend. Look at it. This is what we call, even though you can't see the 40-period moving average, it's not on there. But trust me, they would be what we call declining railroad track, 20 and 40. So it's just steady liquidation. And before it gapped down, you had a big fat green engulfing of, we might bounce here and reverse this trend and start into a new uptrend. But the very next day, it gapped under the big fat green bar. These are so powerful, we even give these a special name in the Pristine Method Part 1. We call this a bearish mortgage play. That all of the bulls in that green bar, partying at the local saloon, the opening print of the day, the next day, it opens under the low, they're holding a losing position. So they're in that green bar, they're trapped. They're like, get me out of here. We short a 5-minute low, stop over the green bar's high, and we teach in TPM 1 that there's one strategy, you can just hold them for 10 days in some cases because they ignite big, powerful moves. And this is a gap breakdown example. And you can see on the weekly chart I put up over here that this confirmed that there was no congestion to the left, and we also had what's called a failed buy setup on support. So we had both time frames here. That's another salivating pattern. Let's see what this happy bear is up to. At the high, if you bought this breakout, you are a what? A loser is the correct answer. But after this DVD, you would, if you follow what we teach, and I tell my students that if you follow what we teach, it is hard for you to lose a lot of money. And if anybody does lose a lot of money, then I say just come to my office or email me your trades, and I will point exactly to where in our manual or my DVD that you are not doing what we taught. And I also, I don't know if you picked up on that, I did it on purpose. I didn't say if you follow what we teach, you're going to become a millionaire. I said you aren't going to lose big. And that's another double negative, but it's for the following reason. Trading takes seasoning. I can teach you everything in these books. We don't hide anything. Everything we teach, we lay it on the line. It's like us all going to Top Gun school. We're all given the same F-14 fighters or stealths or whatever the state of the art is now. And it's all up to the nut behind the keyboard or the pilot of who's going to succeed in that airplane in a gunfight. So having the proper hardware and software and internet connection and education, all that does is put you on an even playing field. That does not guarantee much to the surprise of some of our competitors who tout money-making red light, green light machines, or take my one-day seminar and you'll be making $2,000 to $5,000 1 hour per morning. Pity the fool who's going to believe that without putting in some of the hard-earned sweat and seasoning that it takes to compete with the brightest minds on Wall Street. So again, that's a little psychological detour there, but you would not buy this breakout right here because of what I taught you an hour ago. It was rallying 5 bars to a new high. So you would be a loser if you bought that and you weren't following what we taught. So where you start to make money is following the rules, getting the seasoning, and then slowly getting rid of the demons. Oliver Velez talks about in his trading success process of first learning every possible way to lose. Once you've learned every way to lose and you stop doing those, the only thing left is to win. And that's the way how you succeed in this market, in this business. So are these tradable now? You have the initial gap down. That is a breakdown. It traded under the big gap, but the gap's way too big relative for your reward to risk, so that one would not be playable. And the same with the next one. But then, this one is a daily chart, I remember. It went sideways for like 3 weeks. Now, what happened? The last bar on the chart. That indecision was now resolved at the opening print under that consolidation. It's ready for another leg down. And you have your bullish volume there. You short a 5-minute low, stop over that prior day's high, and you manage in between for another home run play. Now for one of Pristine's most cherished intraday tactics called the late day breakout. This is an incredible, highly reliable strategy that we do teach in the Pristine Method Part 1. I'm going to go into it a little bit more detail in here. And remember I mentioned to you all of the different trade patterns that we teach, particularly for new traders. We don't want them being a jack of all trade and master of none. We want them focusing on a few reliable, high odds patterns and then slowly through time growing their comfort zone of different styles and strategies that they can include in their trading arsenal. This is one that we have every single trader starting out with, provided, again, they can follow the rules. The setup, we're looking for an 8 to 10 bar base or consolidation in a tight range. You know what that means now. We want that to be in the upper 1/3 of a preceding bullish move. That's going to make it get above the 20 MA on the intraday charts. We don't want significant congestion to the left, like any trade. We want the stock to be up on the day and over the prior bar's close. So that's going to make that's going to make the current body on the daily chart be green and above the prior day's close. Then the breakout's going to occur over resistance on increasing volume, and after the 215, what we call the midday doldrums. We want it to occur after Wall Street has typically come back from their lunch, where things are typically very quiet and sluggish. We want the late day breakout to occur after this particular reversal time. Then you buy over resistance, stop under the base, Sell half after a multi-bar move. You just trail it under a prior bar's low. The other half when it gets far from a major moving average, or, as in the case with any trade, at congestion. This one I can now do quicker. It's just the opposite. We want a tight consolidation in the lower 1/3 of the day's range. We want it under the open in yesterday's close. We want to break down under support on increasing volume after the same 215 doldrums. You short the breakdown, stop over the base, cover half after a multi-bar move, other half far from the 20 MA or congestion again. So let's look at a couple of these. Looks like we got our bear in jail right now. So on the daily chart, I'm just showing you that there was a big ugly red bar there that had no follow-through to it. So even though we're trading the intraday time frames, showing you this says that this might produce a multi-bar move in addition to the late day breakout. The hourly was also a bullish consolidation, as you can see, with no congestion to the left. But we're actually trading this 15-minute chart. So it's up on the day, above yesterday's close. It's a tight bullish consolidation all through the lunchtime doldrums into the rising 20-period moving average. That's my setup. My entry is by the initial breakout. You don't have to wait as we did. As long as all the rules are met, you don't have to wait for the wide range bar to close. Is there anything is there anything wrong with using that strategy in this context? No, but many times, if everything's in alignment, the stock's not going to give you the luxury of waiting for you to get on board in another bar or two. So you buy the breakout, stop under the base, sell half after a multi-bar move, or far from the 20 MA. Got a happy bull here, 15-minute chart. Beautiful, strong move earlier in the day. Tight consolidation for a couple hours through the doldrums. So remember again, retracement through time, as we have here, versus retracement in price. So relative to the morning breakout on bullish volume, this stock did not retrace much. So that is a sign of strength. I have what's the significance question mark. That was an attempted breakdown that failed. It snapped right back into the base and went tight again above the 20 MA. You buy the initial breakout, stop under the base, but in this case, it did give you a little inside bar, the next one, so you could have actually added in this case. Add over the wide range bars high, same stop under that bar until it gets moving and you sell some into strength. This one, on the daily chart, I'm just showing you that it was extended and had a bullish gap. It was 5 ugly red bars down, big ugly red bar telling me that the longs, the bulls in there were saying, get me out of this stock at all cost. Then when it gaps up into one of these ugly red bars, that's actually one of our 12 guerrilla strategies that we teach in TPM number 1. It's beyond the scope of this course of teaching you how to trade that, but it's a bullish pattern, and what I'm showing you instead is the 15-minute chart. So I had a bullish daily. It's up on the day on the 15, basing in a tight range. It's above the 20-period moving average. You buy the breakout, stop under the base. There's no congestion to the left. You manage in between. These are 2 different late day breakouts. On the left, I'm showing you the daily and its 15-minute below. And I'm just showing you that the multiple time frames in this example, I have breakouts on 2 time frames. So on the daily chart, remember we talked about messy consolidation. Don't do anything until what? until I have a wide range bar close either deep into the resistance where the next bar might be my breakout or a gap over it. In this case, we had the wide range bar to the top of the consolidation area. Then on the bottom left is the 15-minute chart of that same. Remember in the intro section, we suggested to you when you had that end of day run, as you see on the 15-minute chart, the odds of a retracement were high. Well, guess what? You didn't get one in this case. Instead, on the 15-minute chart, so you got 4 bars per hour, so you can do the math, but it consolidated on that 15-minute chart in the upper 15 to 20% of the preceding day's bullish move. So that's a very bullish consolidation over time. Up on the day, above yesterday's open, tight consolidation in the top third into the rising 20, buy the breakout after the 215 doldrums on increasing volume, stop under the base. It's pretty straightforward. The other example on the right, it is also a breakout on the daily chart, and let's look on our 15-minute chart. Now I want you to make a note of this for the next chapter, but it might be a little hard to see here at first glance, but this one actually had a bearish gap down under support. And then on the 15-minute chart, notice how the gap down was bought aggressively. So it rallied robustly in the first 3 bars, so first 45 minutes, negating the bearish gap down. Then what did it do? Consolidated in the top 1/3 into the rising 20, buy the breakout after 215 doldrums on increasing volume, buy the breakout, stop under the base, and manage in between. Now there's nothing wrong for trading these solely on the intraday time frame as late day breakout, but one of the reasons why I'm periodically just showing you the daily chart also is because in opportunities like this that are breakouts on multiple time frames, there's absolutely nothing wrong with late day breakout, day trading, half or a third or all, whatever your trading plan says. But if your trading plan, like mine does, allows me to hold half of this as a swing trade when the daily chart is also a bullish breakout, that's a form of wealth building. Income building on the day trade, and then pristine wealth building on the longer term time frames. This poor stock is, I think it was IBM, down 15 red bars. Then, on the bottom left, I'm just showing you how the day closed, just so you can see how it gapped up into the red bar. But on the bottom right, you can see the 15-minute chart, how it gapped up from consolidation into the close at the low. So that consolidation becomes what? Support. So it gapped up and went sideways. Then it went sideways on the 5-minute and 15-minute. You just buy the breakout, stop under the consolidation, and this is another example that could be a day trade or swing trade. Because why? There's no congestion to the left on all 3 of these time frames. These are just 3 beautiful independent examples. Top left, up on the day, tight consolidation into the rising 20, no consolidation. Buy the breakout, stop under it. Same on the bottom left, same on the right, with beautiful increasing volume on that breakout. Every single one of these, just quality examples. 4 more quality examples. I could show you hundreds of them, and you'll now soon appreciate why this is one of our favorite strategies. On number A there, big wide range bar going sideways, buy the breakout. Number B, this had a bullish gap and then very tight consolidation in the top little portion of that wide range bar. Buy the breakout. C, bullish gap, tight consolidation, darn near the dead high. Look how flat that is. Both on C and D, the resistance is so flat. So that is people selling their merchandise at that price. I mean, even, I like to use silly analogies whenever it helps. Pretend these are straw hats instead of stock. And you go down to the local flea market, and you have these straw hat vendors. And they are selling their straw hats at $10 a piece. As soon as people come up and they go to all these vendors and they exhaust their supply of $10 hats, then the price, there's nobody left to sell you hats at $10 anymore. So the price has to rise. And then you might have to go deeper to other vendors who say, well, I'll sell you some of mine at $11 now. There's none left at $10, and that's what causes that cap. There was nobody left to sell this stock at that price anymore. So once those sellers are gone, the stock rises 9 out of 10 times. The one on the right, same thing. This one had a beautiful bearish gap down, so you TPM2 people will pick up on the nuances and everything we do. But it had a bearish gap down that rallied aggressively, sliced through resistance, consolidated into the rising 20, buy the breakout, stop under the base. Here's one scan. Many scans find these. I gave you a list of them earlier. But here's one in the Pristine ESP, just basic scan called above average up volume. So unusually high volume in the morning periods are often associated with brand new moves. So this was a breakout earlier in the morning, but this particular scan wouldn't pick it up most likely for 10 to 15 minutes. So this wide range bar would be completed already by the time we found it. But I would say to myself, wow, look at Atmel here. ATML is a wide range bar breakout on this time frame from the previous consolidation. And I would keep it on my watch list to enter. You know the drill. I talked to you in the earlier chapter. How do you enter this? First retracement. So you would look for a 3-bar pullback into the wide range bar. Did we get that? No. Did we get a secondary breakout? No, because we didn't get a retracement. So how else can we enter this stock? Late day breakout. If it doesn't retrace over price, then you can see it here basing at the top of the day. In the upper third, up on the day, even though I don't have a 20-period MA here, it's probably going right into it. I would buy the afternoon breakout, stop under this consolidation, manage in between. A little quiz here for you. Let's see what we can identify. I'm showing you the excuse me, the daily. Big wide range breakout on the daily corresponding with A. So what is A called? A late day breakout. Because that was a 15-minute chart. So that was a late day breakout on the 15 that was also a breakout on the daily chart. Then B, letter B on the 15, was a breakout the following day. That was probably in the morning because 15-minute chart, you got to add them all up and see how many hours that was. But number C was a perfect late day breakout on increasing volume. You buy over the resistance, stop under the base. After a multi-bar move, you sell half or far from the 20 MA, and your trading plan will dictate how to handle the back half. Letter D, you got another breakout. What about E? Now D, keep yourself a note on D. That could have been a false breakout, which our remaining chapter, I'm going to address some of those. E looked like a breakdown that then failed. So F now, and this is how sometimes, traders get shaken around a bit, and again, that's life. I'm not here to show you picture perfect ones to give you a false sense of security. I highly, highly recommend, I'll just give you one of the concluding notes right now, when you're done with this DVD, just like any of our seminars, don't go out there and start firing away at things. Paper trade these. You can actually go into Pristine ESP and back test through our market search function and find breakouts and then look at them and study them to see which ones worked, which ones didn't, and try to find out why. Why did these work and these didn't? And that's where you get the confidence in your trade patterns is through experience and seasoning. I can sit here and tell you over and over again about the quality of a pattern, and don't short this one and don't fade this one, and until you get the seasoning yourself, then that's just like a child learning to walk. It's normal in this business. So E was a false breakdown. F is telling me that was a false breakdown. That F was a breakout, wide range bar breakout that was resolved to the upside now. So what rule do we deploy on that? It's not a late day breakout, right? But it's just a breakout wide range bar that closed out of the consolidation. So you would buy over the high of that green bar, stop under the low of the green bar, the F bar. Late day breakdown is just the opposite. So this one we have down on the day, below the prior day's close, because we want the current daily bar to be red, remember. Basing at the low, basing and consolidating near the low into the declining 20. Short the breakdown, stop over the base, manage in between. For just examples here, again, I could show you hundreds of them, but there's really no need to. Every single one of these are great. Number A, down on the day, basing in the lower 1/3 into the declining 20. And for you TPM2 people again, you notice on A, the slight little false breakout makes the breakdown even more delicious. On number B, Bravo, down on the day, under the close, tight basing. Remember our discussion about all the bulls who bought in this base? They're going to say, the heck with this noise, because somebody bought in there by definition, or else there wouldn't be a print on my chart. So once they sell to close and I sell to open my new short trade, there's nothing for this stock to do except collapse and put money in your trading account. Number C, I would say, is the whippiest of them all. However, the reason I put it here, it's whippy consolidation all in the bottom half of one ugly red bar, whereas the other ones were multiple drops and then a consolidation. So consolidations, as you see here and other examples in the DVD, if it can't bounce over 50% into that ugly red bar, and remember our discussion on the topping tails, so those tails are I call those topping tails bear tracks, TRACKS, because it's a track or remnant of a prior intraday battle where the bears won that particular bar. So that tail is a track of a bear. Continues to base at the low. I got the declining 20 coming. Short the low, stop over the prior tail. Number D, very, very tight basing. So this could be the flip of my straw hat example. You have people buying stuff at $10. Once the buying stops, they said, I don't need any more straw hats. I'm done buying. And the sellers say, well, darn it, I can't go home until I sell all of my straw hats. then they have to drop the price of their straw hats to liquidate their inventory. There's no other way around it. Here's how we use Pristine ESP to find these candidates. You right-click in the taskbar and go to Scans. Then you go to Micro Trader. Then I have 4 of them here for you that will find these. 15-minute basing, gap down and weak, and these obviously are for the shorts. The flip is for the longs. Last trade at the low on stocks near the lower 2% daily range. And I just leave the little Pristine ESP box up, and it'll just send me ideas. And then it's up to the individual trader to then apply the Pristine method to determine not only if it's a quality setup, but to make sure in its accordance with his or her trading plan and the other requirements of the trading checklist are all there. Remember, patience and discipline to follow your method. The last chapter I'm happy to present here for you because it's something that we've followed over time, and it's just a unique setup that if you then get a late day breakout, then it's even more powerful. So I'm going to call this late day breakout or breakdown following a gap that was negated. Now here are the words, and then obviously I'll show you the visual here. So we have an oversold stock, red bar, red bar, red bar, red bar, red bar, with little congestion to the left. So the multiple fluid drop is getting oversold. Then it gaps down significantly, kind of like a novice gap that we talked about. But then it rallies strong at the open on increased volume. On a 30-minute chart, so in the first 30 minutes, so it's either a 30-minute chart, 1 bar, or it's a 60-minute chart, but it's only looking at the first 30 minutes. So at 10 a.m. Eastern Time, you have a wide range bar that has gone, it's either at the gap down resistance or it's gone through it. I want the wide range bar to have a very small, if any, bottoming tail. Because remember, a tail would suggest further selling. But I want this gap down to be bought, because it's a novice gap down. Once that's done, I'm looking for a bullish entry, enter, and manage in between. And the opposite for the bullish gaps that I'll show you. So my daily chart here, I had a bearish gap under all of this support. So that is very bearish, and it looked like the stock was ready to make a big multi-day another drop. So I would have come to the market wanting to short a small bounce in this particular pattern. However, let's look at the 5-minute chart. In order for me to want to short this, I wouldn't want it to retrace more than 50% into the gap. But notice how this stock in the first 30 minutes, because this is a 5-minute chart, so you have 6 bars in 30 minutes, it totally filled the gap. Once you see that, and I have no congestion to the left, then I figure out how to get on board. And so that has to be a bullish pattern per your trading plan. But for the purposes of this DVD, we're going to be talking about what I taught you. First, retracement. So it filled the gap, red bar, red bar, red bar, red bar, bottoming tail, I buy over the high. Then I have 3 areas that I've highlighted here for you that I've taught you in this DVD that you can add to this position. I have a bullish daily. The bearish gap was negated, and we call it the bearish gap that bullies resistance because it was negated in that first 30 minutes. So you can see there I have an initial breakout, then I have an add breakout, and then a consolidated over time, and that turned out to be a late day breakout, the third one, just because of the time of the day. Here's another example. Bearish gap down. Let's start with the daily at the top left. The stock is down, 10 red bars, far from the 20, and that's an ugly gap down. So on the bottom left is my hourly chart, or it can be 30-minute for the purpose of this, but all you need to know is in the first 30 minutes, I have a big wide range bar, little to no tail. Now, look at my 15-minute chart, it rallied up to the gap, didn't retrace through price, but instead consolidated through time. It's up on the day, above yesterday's close, above the 20 MA, and breaks out after 215 on increasing volume. You buy the breakout, stop under the base. Follow the rules, manage in between. Here's one now where it's a bullish gap that fails. And we elected to name this the bullish gap that buries, because it's bearing deep into support. So I actually have two examples here for you, showing you the 30-minute chart. The first one, number one, bullish gap, deep, fills the bullish gap in the first 30 minutes. I'm shorting some kind of breakdown or other bearish entry based on your trading plan. So on both of these examples, you can see the bullish gap up totally negated, and these would had a little bit more difficult time to get on board. They would be called a bearish 1, 2, 3 continuation. So once you had the next wide range bar down, the little inside bar, you would short under the low of that next one as your entry on this. And there's no support to the left. That's what you're looking for. Here's how I find these patterns. Go to Scans, MicroTrader. If something gaps down and strong, that means it's near the upper part of the day. And so that's the one on the left here. I had 17 candidates at this particular morning. And as I mentioned with some of these others, every single morning I have this pristine ESP box open. I don't have it this big. All I need is the symbol. That's all I care about, because I'm making all the other decisions. So I have a small, narrow box, and I have a bunch of them lined up. And when it populates every 60 seconds, I just click it on. And then I know whether or not, in accordance with my trading plan, in accordance with what I'm showing you in this DVD, whether it's quality or not. And then to find the weak ones, gap up and weak. So that means within the morning session, they've negated that big bullish gap. Before we give some concluding thoughts, just wanted to show you one little summary slide here of our services and education that Pristine offers. It's no accident that Pristine has been around. We're on our 12th anniversary here coming up, and been ranked the #1 educational firm by Barron's, Forbes, and Stocks and Commodities magazine. I've been associated with them over 9 years and believe they're the Rolls-Royce in the industry. And we don't sell false hope. We sell rock solid education. I strongly urge you to if this is your first experience with Pristine, then congratulations. I hope we fulfilled our promise to deliver 100 times the value of what you paid for this DVD. I strongly believe that you have, if you follow all of its messages in it. But don't let that be the end of your journey. Let it be your beginning. You really, if you want to master this business like anything else, you think Michael Jordan became a pro basketball player just by, practicing a little bit on the weekend? You need to take it serious. Get some education that we offer. Pristine Method Part 1 and Part 2. We offer these real-time trading rooms that I mentioned. We have 3 of them that gives you hands-on guidance throughout the entire market day. We have active newsletters to advanced ones. We have coaching online and person, the beginning and advanced labs that I mentioned. But our goal is to give you the tools to make your own independent decisions. when I told you I've been trading 9 years full time, that was a little bit of unclear, because I actually was trading 15 years before that with a full service broker. But guess what? I don't count that. I'm only counting my 9 years of active trading shortly after I started with Pristine. Because at that point in time, I had the broker just telling me what to do, and I had absolutely no idea why I was getting in stuff and getting out of it, and I didn't want to blame him. So I took it upon myself to get the education, so I have nobody to blame except myself. And that's why I think this is the most phenomenal business in the world, equipped with a 13-inch laptop and my internet connection. I can go anywhere in the entire world and I can trade a market. I know how to go out there and look for opportunity, see if the odds are in my favor, enter it, and manage in between. That's a marvelous sense of accomplishment and self-being, and that is our goal with Pristine. Let us continue to be your mentor. Don't be a stranger. We're all very easy. All the educators are easy to contact. Just you can email Pristine Corporate, or I'm Dan at Pristine.com, and we wish you the very best of your future progress with Pristine and on your own. So at this point, you have the information to build on. It's up to you to make this material your own. I've given you very concrete and specific different types of high-quality breakouts and breakdowns. I've given you some examples of when you want to wait for the decision to be more clear in relation to the battle between the bull and the bear before jumping on board. And bear in mind that, as I mentioned, we only shared with you one or two of our compelling patterns, and there's many, many more out there, but hopefully you can appreciate that this took the subject that we do cover in the Pristine Method Part 1 to a much deeper level. There are no secrets or proprietary information out there on the street, much to the dismay of many. Just defining the opportunity, having the discipline to follow your rules and money management rules is all you can do. And it's another trade under your belt. Make every single one count and then learn from them. And we teach you how to analyze your trades after. Every single trade should be a learning experience. And some people get mad saying, oh, well, that one didn't work. They aren't meant to all work. That's like a pilot flying and saying, oh my God, I had turbulence today. Well, guess what? You're a pilot. That's normal. We're odds players. We're professional odds players based upon the charts. And as we're suggesting here in these words, all we're doing is waiting for the technical setup and the odds to be in our favor. We have no idea what's going to happen next, but we do provide you the tools to know how to objectively react to absolutely anything that the market can throw your way. In closing, at Pristine, we wish you tremendous success and good luck with all your future endeavors.